truth is, sovereign debt is not like household debt. A country almost never pays it down to zero. It rolls it forever, issuing new bonds to pay off old ones. The game only works as long as someone is willing to keep buying the new paper at a price the government can survive. So who are those buyers in 2025? For the United States, $36.2 trillion outstanding. 1/3 is held by foreign central banks and sovereign funds. Japan, $1.13 trillion. China, $759 billion. The UK, Belgium, Luxembourg, Cayman custody accounts that hide hedge fund ownership. 1/4 sits on the Federal Reserve's balance sheet, $6.8 trillion after the latest quantitative tightening round. The rest is scattered across American mutual funds, pension funds, insurance companies, banks, and the Social Security Trust Fund. Japan is the mirror image, 1,280 trillion yen, more than 90% domestic. Bank of Japan 43%, Japanese megabanks, insurance giants, Japan Post, and the world's largest pension fund, GPIF. Foreigners own less than 9%. Italy. 2/3 of its €2.9 trillion is now held outside Italy, mostly by the ECB, French and German banks, and global bond managers like PIMCO and BlackRock. Emerging markets have changed completely. 20 years ago, their debt was almost all in dollars owned by Wall Street. Today, roughly $18 trillion of local currency bonds sit in global indices, owned by the same yield-chasing funds that hold U.S. Treasuries. That is the critical shift. The marginal buyer for almost every sovereign on Earth is now the same concentrated pool of cross-border capital. When that pool decides to leave, the mechanics are brutal and instantaneous. First, yields explode. A country that was paying 2% suddenly faces 10%, 20%, or 100%. Interest expense eats the entire budget overnight. Second, the currency collapses as investors sell bonds and scramble back into dollars. Imports become unaffordable. Inflation rips through wages. Third, the collateral chain freezes. Sovereign bonds are the bedrock of repo markets and derivatives collateral. When they lose their risk-free status, haircuts widen, leverage players get margin calls, forced selling accelerates. At that point, the government has 3 realistic options, non-pleasant. Option 1. Explicit default or restructuring. Argentina, 2020, 45% net present value loss for bondholders. Lebanon, 2020, 97% haircut on Eurobonds. The legal battles last decades, capital markets stay shut for years. Option 2. Inflation as the stealth default. Print money, destroy the currency, impose capital controls. Real debt burden shrinks, but pensioners and wage earners lose 50-90% of purchasing power. Zimbabwe, Venezuela, Weimar. Option 3. Supranational rescue with brutal conditionality. Greece received €289 billion in loans in exchange for a 25% GDP contraction, pension cuts of 60%, and the fire sale of ports and airports. There is no fourth option. Big countries are not immune, they just die differently. Japan's household saving rate is already negative. When the domestic bid vanishes, the Bank of Japan will be forced to monetize 15-20% of GDP every year forever. The yen goes to 300, 400, maybe 500 per dollar. The United States issues roughly $2.5 trillion net new debt annually. Foreign official buyers have been net sellers since 2022. If global funds ever decide 5-6% yields still aren't enough compensation for dollar debasement, the Fed restarts QE at Depression-era scale. Reserve currency status erodes in a decade, not a century. The United Kingdom gave us a live-fire demonstration in September 2022. 6 weeks of bond market rebellion forced the Bank of England into emergency purchases and reversed an elected government's fiscal policy in days. Every historic empire that borrowed in its own currency eventually discovered the same constraint. When the marginal buyer walks away, the printing press is the only bidder left. The result is always the same: inflation, financial repression, or both. Who pays the real bill? Never the concentrated owners of capital. Losses are socialized onto the dispersed middle class through destroyed savings, higher taxes, and slashed public services. Greek pensioners, Argentine depositors, British mortgage holders in 2022, American retirees in the coming decades, same story. Global public debt now exceeds $105 trillion. Interest as a percentage of government revenue is already at levels seen only in pre-default episodes across history. The buyers are exhausted, the mathematics no longer work. When the music finally stops, the collapse will not be gradual. It will be non-linear, contagious, and irreversible. And the only remaining question is whose bonds your pension fund, your insurance company, and your central bank own when the last rational buyer finally says no. Because right now, in December 2025, we are deeper into the endgame than any headline admits. Italy needs to roll €420 billion of BTPs in the next 12 months alone. Its banks are stuffed with €420 billion of unrealized mark-to-market losses on those same bonds. One more 150 basis point spike in yields and the entire Italian banking system is technically insolvent again, exactly like 2011. Except this time, the ECB's balance sheet is already €8.3 trillion, and the transmission protection instrument has never been tested under real fire. France is quietly worse. Gross debt, 112% of GDP. But net interest expense is already 2.8% of GDP, and rising faster than nominal growth. The moment the haute bund spread blows past 120 bits per second for more than a few weeks, French life insurance companies, which are forced by Solvency II to hold 60-70% domestic sovereign paper, start bleeding capital. That is €2.4 trillion of household savings that suddenly can't meet guaranteed returns. China's local government financing vehicles owe an estimated $11.13 trillion off balance sheet. Most of it is collateralized by land that has fallen 30-70% in value since 2021. Beijing can keep swapping bad debt for new central bank liquidity until the PBOC's balance sheet becomes larger than Japan's as a percentage of GDP, which will happen sometime in 2026-27 at the current pace. And then there is the United States Social Security Trust Fund, $2.7 trillion of special issue treasuries that are non-marketable. Every year, the Treasury has to redeem $250 billion of those specials with fresh, marketable debt. In 2033-34, the redemptions jumped to $800 billion, $1 trillion per year. That is an automatic legislated increase in net Treasury issuance at the exact moment the boomer drawdown peaks and the Fed is trying to shrink its balance sheet. There is no historical precedent for absorbing that supply without either 7-9% yields or permanent Fed purchases. These are not predictions. These are actuarial and accounting certainties baked into the current path. The only variable is the trigger. It could be a Japanese megabank finally admitting its JGB cross-currency basis swap book is underwater by 40 yuan trillion. It could be a European money market fund breaking the buck on a French repo. It could be a large EM index giant, Turkey, South Africa, Brazil, missing a coupon and discovering that nobody steps in because the IMF is already maxed out on Argentina, Egypt, Pakistan, and Ukraine combined. Once the first domino falls, the correlation across all sovereign credit goes to 1. Risk parity funds, target vol strategies, and liability-driven investors are forced to delever simultaneously. The dash for cash becomes a dash from everything that isn't physical dollar bills. We saw the prototype in March 2020, except that time the Fed stepped in with unlimited firepower within 72 hours. Next time the Fed will be one of the stressed parties, not the solvent backstop. And when the smoke clears, the new equilibrium will be one of 3 worlds. Chronic financial repression, caps on yields, forced allocation, capital controls, negative real rates for a generation. Think Japan on steroids globally. Fragmentation, the end of the single global sovereign bond market. Return to 1932 style currency and capital blocks. Dollar block, Euro block, if it survives, RMB block, maybe a gold-backed BRICS fringe. Overt defaults and debt jubilees, politically unthinkable until the moment it becomes the only remaining option. The 50-70% haircuts that academics whisper about in closed-door conferences become the new baseline. History says we won't get a clean choice. We'll get all three in different regions at the same time, layered on top of each other in the most disorderly way possible. So zoom out and ask yourself the only question that actually matters today. Who is the price-insensitive buyer of last resort for your country's debt tomorrow? For most nations in 2025, the honest answer is nobody. And when that becomes visible to everyone at once, the greatest wealth transfer in human history will already be underway. From those who believed governments could never fail, to those who positioned for the moment they inevitably do.